Hi all, welcome to Bond Bytes, the daily bond market highlights from INRBonds. I'm Arjun Patsarthi, and with markets flat waiting for Fed Jackson Hole conference to take place and nothing happening up in yields, we concentrate on gold today. Gold, would you like to invest in gold directly or in gold bonds? So what are the options in gold? You have gold ETFs. And if you see the chart in our screen on the left, you see that prices have come down. So if you invest directly in ETFs, you do have questions of volatility in prices, even though over a longer period of time, the chart is showing an uptrend. Maybe it's a timing effect, but having said that, you also have options of gold bonds. So you have bonds, which is the government is running a series of sovereign gold bond issues. Now, these sovereign gold bonds are bonds that have the backing of the government of India. You have a fixed coupon rate of 2.5% per year, and then the rest of the bond is linked to gold prices. So clearly, if gold prices rise, then there is capital appreciation, and if gold prices fall, to some extent there is protection against the fall because there is a fixed coupon. And then you also have the option of investing in bonds of lenders against gold. So Manappuram Finance and Muthoot Finance are two of the largest lenders of gold in India against gold, with a long track history of good track record. And so their bonds are trading at levels of around 7% for Manappuram, 2-year bond. And for Muthoot, it's 2 and 3-year bonds are trading at 6.1 and 6.45%. So are these better off? Because these are fixed cash flows, and with their track records, they do seem to offer a good comfort of safety, given that gold as a collateral is a very liquid collateral in India. But having said that, the results have not been really forthcoming for both of them. Manappuram did, there is a slight dip in growth, and over the last 1 year, and with gold prices also falling, then there are concerns amongst investors that the collateral value itself is going down, and whether they could be able to recover any kind of defaults. That's why the bonds are trading at these levels, but with their loan to value ratio at very uh, with the loan to value ratio giving them a good cushion against defaults, these companies are able to show a good, healthy capital adequacy ratio and reasonably good balance sheet strength. So you would have to decide whether you can invest for steady cash flows in bonds of companies that lend against gold, or the sovereign gold bond itself that can give you very good, decent capital appreciation if gold prices rise, or the gold itself through ETFs. But the volatility there is volatility in that as well. We are pleased to announce that we have scheduled a webinar for generating monthly cash flows on the 4th of September, Saturday, 11 a.m. I will be talking with panelists to show the best way to generate monthly cash flows for those who require that, right? So there are many requirements, many people who require monthly cash flows, largely to meet day-to-day living expenses or to meet some of their other expenses. And what is the best possible portfolio that they can build? So it should be a highly educative webinar for those who are looking to invest for a steady cash flow kind of portfolio. And please do subscribe now. And subscribers get a free subscription to INRBonds QuickInvest, the retail bond platform, where you can buy the best bonds for you at the in the most seamless electronic manner. So register now. The registration link is given in the description below. The price for the webinar is 200 plus taxes. Thank you for watching. I'm Arjun here signing off.